Moving on to part 5 and the concepts of capital. This is probably the least important area of this session, but there are still a couple of things in here that are well worth having a look at. First of all, the concept of financial capital. Financial capital is basically the difference between the net assets at the beginning of the year and the net assets at the end of the year. And profit is the difference between the two. The financial capital is the resources that are available. So profit is earned if the net assets at the end of the period are more than the net assets at the beginning. There could well be distributions to and contributions from the owners. Distributions to the owners would be dividends or drawings if it was a sole trader. Contributions from the owners would be shares, capital introduced, or just capital introduced for a sole trader. So the profit for the period is the difference between the closing and the opening capital, and the closing and the opening capital is the closing and the opening net assets. Add any distributions, take off any contributions. Add any dividends, take off any capital introduced by way of shares issued. Physical concept of capital. Profit is earned if the physical productive capacity at the end of the period is more than the physical productive capacity at the beginning of the period. Profit in this case is just the difference between the closing productive capacity and the opening productive capacity. Same principle, slightly different terminology. Capital maintenance is all about, maintenance is keeping something at a certain standard, isn't it? Capital maintenance is maintaining the value of your business. Financial capital maintenance sets aside profits in order to maintain shareholder value, potentially after adjusting for inflation, although that is not always going to be the case. Giving us an illustration here. Company starts trading on the 1st of January X3 with capital of 10,000. Uses this capital to buy 1,000 units at $10 each. So it's used up the capital of 10, but then sells for 11. Opening capital is 10. Closing capital is 11. Profit is 1,000. Okay, so capital has not only been maintained there, capital has been increased to a certain extent, hasn't it? But if you then add in the impact of inflation, comparisons over time, even over a year, like it does on the left-hand side there, comparisons over time can become difficult due to inflation. So this concept here of financial capital maintenance adjusts for inflation. I think you need to know that this might be the case rather than actually do it. If the retail price index is 3%, in other words, inflation is 3%, that means that our opening capital that was 10 on the left-hand side has increased by 3% to 10,300. Therefore, the profit is the difference between the inflated value of capital of 10,300 and the fact that we sell the goods for 11,000. So this time we're saying profit is 700. More realistic figure? Maintaining capital, isn't it? Maintaining the capital and keeping it at a recognised reasonable amount will therefore have an impact on the amount of profit that's generated. Physical capital maintenance sets aside profits to allow the business to continue operating at its current activity levels, which still means that we're going to end up potentially adjusting opening capital for specific price changes. Based on this concept, even if the profits are distributed, the productive capacity of the business is maintained. An example of this works in a very similar way actually. Entity starts trading on the 1st of January X3 with capital of 10. Uses to purchase 1,000 units at $10 each, which are then sold for 11, which is exactly the same as what we had on the previous slide. Profit is usually measured at 1,000. However, over the year, the price of a unit increases to $10.40, which reflects a 4% increase in the price. This is not adjusting for inflation as such. It's adjusting for the fact that the original capital is now actually worth more. So the opening capital will be increased by 4% to 10,400, which means the profit is only 600 as opposed to the 1,000 that would have been dealt with originally. So whether we're talking about physical capital maintenance or financial capital maintenance, got to make sure that the original capital is adjusted to a reasonable value. And if you use physical capital maintenance, it will always be done as it is here. If you use financial capital maintenance, including inflation, will do effectively the same thing. I know the percentages are different, but it will effectively be the same thing. That brings us to the end of session 1. Remember the 5 sections that we've looked at? We had a general introduction to the conceptual framework. We then looked at individual component parts of it, which included the characteristics of information, the elements of the financial statements, measurement of those elements, and then a little bit about the capitals and capital maintenance.